Welcome to the True Wealth Podcast, where we specialize in helping aspiring homeowners break into the real estate market and help investors create and build wealth through real estate. We will be sharing some of our best advice around real estate so you can purchase your first home or grow your real estate portfolio, increase profitability, reduce taxes, and achieve financial freedom. Your host, Seun Adeyemi, is a certified financial planner, mortgage professional, and fellow investor. We want to help you get real so you can pursue your investing dreams with confidence. A real estate acquisition lifestyle is within your grasp. Financial freedom is possible when you have the right mindset, coaching, advice, and community. So, let's get real.
Welcome to the True Wealth Podcast. I'm your host, Seun Adeyemi. Today, we're going to talk about co-ownership of real estate, with runaway real estate prices in the GTA. Many buyers are finding it really hard to get into the home market, into the real estate market. And so today, we're going to talk about co-ownership. Sometimes you may even have enough income, but may not have enough down payments. And so maybe co-ownership is a strategy or is a way to get your foot into the real estate market. And so today we're going to interview Alex from Ourboro. She's going to tell us all about what Ourboro is about and how they can help you as a aspiring homeowner get into the real estate market. Alex, how you doing today?
I'm great. Thank you so much for having me.
So I heard about Ourboro maybe about 2 months ago. Never heard of you guys. And I thought this is an interesting concept. There are a few other co-ownership options out there in the marketplace, but Ourboro seems a little unique. So I thought, why not bring you guys on and just talk about what your program offers and how that can help owners. So tell us a little bit about Ourboro.
Of course, yes. And you're right. There have been many models that have been looking at ways to be able to help people get into homeownership, because we know that residential real estate or home ownership has been one of the most stable forms of wealth creation for across generations, for hundreds of years, arguably. But less and less people are being able to break into the housing market because of rising property prices, but also this gap to buy a property in Canada that's over $1 million. You need 20% down payment. That's $200,000 cash saved just to get into the market. And if you look at any urban areas, right, where the average price of a home is now well over $1 million, it's absurd to think. So how are people doing it? They're accessing the bank of mom and dad. A large, I think almost a third of Canadian first-time home buyers that are getting into the market are getting money from the bank of mom and dad. And for the rest, they're either saving for a very, very long time, or, they're moving out of the cities and neighborhoods where they live and work, and where their children may go to school. So they're making these big compromises. So Ourboro, we are the first shared equity platform in Canada, privately funded shared equity platform. So we manage an investment fund on behalf of accredited real estate investors who would rather help people own and live in the homes that they are able to take care of than being landlords, right? So that's kind of a really key distinction. So we have a pool of funds, and we deploy those funds into down payment contributions alongside home buyers. So what Ourboro does is we say, we'll contribute towards a down payment, and in exchange, whatever proportion of the down payment we contributed, we get a corresponding share of the future profit. Just the profit portion, not the full future value, right? Just the increase in the value of the property. So, an example would be if we went halvesies on the down payment, then when the home is eventually sold, we split the profit 50-50. So we called, we're professional co-ownership. People have been co-owning for a long time. You could have friends or family.
That's right,
that you co-buy a property with, and you share the space and you live in it together. So a professional co-ownership, we're like, well, you get all the benefits of having somebody helping you with that initial down payment contribution, but you don't have to share the space. And moreover, while you're in the property, we offer programs and services to support you in being a successful and confident homeowner, because our incentives are aligned. If you're a successful homeowner, you're taking care of the home, that property is going to increase in value and we're both going to benefit.
And usually when people are co-owning, if they're co-owning with a family member, sometimes they're living in the same space. If they're co-owning with a non-family member, it means that they're investors in there. And so there comes in, okay, so how do we handle the mortgage payments? If we were to rent out this place, how much would we potentially get out in rent? And if one of the owners is living in the property, there becomes a question of how do we make this equitable where you're living in the property, which if it were rented out, we would get X amount. But now because you're living in the property, how do we determine who's responsible for what, right? Yeah. So how does that work with Ourboro in the sense that you contribute into the down payment with me, buy the house, we're both owners on it. How does that work?
That's a great question. And you kind of queuing me up nicely to be able to talk more about the product. So it's a question that we get a lot of, what happens when I'm in the home? Like, how do we share the finances? A really important point, which is if you are co-owning with somebody that's not Ourboro, right? If you're co-owning with another party, if that party is living in that property, amazing. You're sharing the space. You will have some sort of agreement that outlines how you each contribute, say like by square footage. You have the upstairs suite that's bigger, you contribute more towards a mortgage. Proportionally, you do like 60-40 split of everything, right?
Right.
It's easy when you kind of living together. If you're buying, say you had like an investor or say like a wealthy uncle who's like, okay, I'll invest with you. I'm not going to live in the property. You get to live in the property. Most likely is they're going to charge you rent. Like if they own 50% of the property and they're not living in it, you will be paying rent, right? For the portion that you don't own.
That's right.
The difference with Ourboro, it's a key distinction, is that we are an equity partner in the sense that this is not a debt obligation that you owe us. There's no interest. You don't pay us anything while you're in the home. You do not pay Ourboro rent, but you are responsible for all the costs associated with taking care of the home. So we made it fair. You're living in the home. You're enjoying it 100%. You don't pay Ourboro rent, so you pay for the mortgage and you pay for the property taxes, the maintenance and upkeep. The mortgage part is important because yes, you are making the mortgage payments, but whatever amount is going towards principal, you actually get back when the property is sold. So in our model, when the property is sold, the first parties that get paid, so you have your purchase price, and then the first party that gets paid is obviously the bank. Whatever mortgage is outstanding is paid back.
Right.
And then we say, how much of your original mortgage have you paid off? So say you paid off $100,000 towards your original mortgage, you get that back first as a priority payment. So it's kind of like getting your rent payments returned to you. Mm-hmm. About the interest portion is your expense, right? That's part of the expense if you get into it. Enjoy the home, right. The cost of borrowing. So after the bank is paid and you get your mortgage principal back, if there's an amount left, that, that's the pure equity portion. That's what we then, 50-50, 60-40, whatever our original contribution was. So all of that, Ourboro makes it quite simple. We have a robust co-ownership agreement that our co-buyers execute, and it outlines everyone's rights and responsibilities. What are you responsible for when you're in the home? What happens if you make a renovation or if you want to do a major improvement to your property? That's all outlined in our agreement.
So you brought up 2 points that are the things I wanted to ask you about is many times when we're defining equity in a property, we're generally looking at what's the value of the property and what's the mortgage balance. Mm-hmm. And that's the general term when we think about that's how much equity in the property. But for the sake of this co-ownership agreements, that's not exactly the same definition in the sense that if I purchased a property for $700,000 and the mortgage on it I started with is $500,000, but I've paid down the mortgage to $450,000. Generally, we would look at the equity as $450,000 to $700,000. That's, if my math is right, $250,000. That's the general definition of equity. But in this case, the equity really is the $500,000 to the $700,000.
That's
because correct. The owner has paid $50,000, so they get that $50,000 back first, wow. And then the difference between $500,000 and $700,000 is what is then split based on the co-ownership and the equity stake each partner has in it. Is that correct?
That's exactly right. I mean, we use the word equity with this assumption that everybody understands what it means. And we know that it's a pretty niche term, right? When you're talking about equity,
Right.
etc. So one of the ways we use to explain it to people is if you look at what people contribute on day one, that down payment contribution, it's risk capital. We call that as equity. It's a risk capital. There's no guarantee that either of us are going to get that money back, right? That's what we call it, risk capital. The remainder 80% that you finance from the bank, that's debt that you owe the bank no matter what. The property could sell for $0 and you still have to pay the bank back that $500,000. And so the bank, it's guaranteed. And so the interest rate on it is, it's cheaper capital because it's for the bank, at least because it's guaranteed. For Ourboro, that's the risk capital. If the property sells for lower than what we bought it for, we're at risk of losing our investment, if not all of it. And we accept that risk. I mean, that's the benefit of us being able to have a portfolio of investments across the board so we can diversify. And, in the event that property does decrease in value, the buyer arguably is more protected. They put in less money upfront, so they insulated a bit more from that. So it's the downside scenarios that really does set us apart.
So there are a few rabbit trails here. I'm trying to figure out which one to go on first. Let's go back to the equity in the home. So what happens let's go back a little bit. So in order for you to be a co-owner, what's the minimum down payments a buyer has to put in, and how does it determine how much Ourboro comes in alongside the buyer?
Yeah, great question. So we do have criteria for your listeners or those watching. We do have criteria. I mean, you find them on our website that we're quite clear. But in terms of the financial criteria, is our home buyers have to come to the table with a minimum of 5% of the purchase price, in other words, a quarter of the down payment. So our home buyers can contribute anywhere from 5% to 15% down payment, and Ourboro essentially tops up the difference to get them to 20%. We don't go over 20%. All our properties are always at 80% LTV because our argument is 20% is what you need to get into the market. We're there to help as many people get into the market as possible, not to further pad the equity so that folks are basically you need to have you need to have income and borrowing capacity to qualify for 80% mortgage.
Okay, got it. So if as a buyer I do have enough in terms of my income to qualify for 80% of let's say 800,000, but my challenge is getting to the 20% down payment.
Exactly.
So if I do have 5% down, then Ourboro comes in with the additional 15%. And that's key because then I don't have to worry about the mortgage default insurance that would typically come on a loan if I am only putting 5% down.
That's exactly it. We're talking the same language. And it's actually, that's for those properties over at $1 million or above, you have to have 20%. And you can't buy, right?
That's right.
There's no mortgage insurance available. So you have to have at least 20% down. And it's actually really interesting for properties that are below $1 million, because if somebody say buying a property for $990 or just just south of $1 million, they have the option to put 5% down and own on their own and kind of have 95% of the value of the property as a mortgage. But with mortgage insurance up to 4%, what ends up happening is their property is leveraged 98, 99%.
Right, because of the mortgage insurance. It's not simply a easy math of I'm putting 5% down and then the 5% is the mortgage. The mortgage insurance is added to the mortgage balance.
Exactly. And a lot of people, I shouldn't say a lot of people, but many people don't realize that. And that mortgage insurance is on your mortgage. You're paying interest. There's a principal amount, and then you're paying interest on that through the lifetime of your mortgage. And also, you've saved, you've worked so hard to save that 5% and to realize that you have so little equity on your property on day one with that initial 5%. So for those below $1 million, it's a bit of a game changer as well too.
So let's talk about we purchased this property together. The investment is doing well, and I decide, you know what, I want to build a deck. I want to improve the market value of the property.
Yeah.
How does that work with regards to the co-ownership agreement?
Yeah, that's great. I mean, one of the things that we take a lot of pride on in our co-ownership agreement is creating these like alignment of incentives in terms of the co-ownership agreement encourages the types of behaviors and actions that benefits both parties in a way. And so when it comes to renovations, we absolutely want our buyers to be able to take care of the home and to feel incentivized to make those investments and improvements in the property. We never want them to feel like if they're investing money in improving the property, Ourboro is sharing disproportionately in those gains.
That's one of the things I was getting to. Like, if I put in $20,000 into the property to upgrade it, and this $20,000 actually improves the property by another $30,000, but I still got to split that $30,000 additional with Ourboro. How does that work?
Exactly. So we have a program within our co-ownership agreement around renovation credits. So when you are contemplating a renovation, anything, I mean, Ourboro could be notified. If it's a major improvement, it's basically in your best interest to inform us if you're thinking of an improvement to the property. Because then what we go is we look at the changes that you're making and we determine if that will increase the value of the property. Sometimes it doesn't, if you're doing cosmetics.
That's right.
Sometimes it doesn't. But if it will increase the value of the property, we'll give you a renovation credit that's equal to like the lesser of how much you've paid for the renovation or the amount of the increase. So even if you put $20K towards renovations and it's increasing the value of the property, but most likely it's only going to increase by like $10K, you get a $10,000 credit. And
got it.
Yeah, and that credit, it's not cash on day one. It's a really important distinction. It's a credit that you get when the property is sold. You get a larger share of the proceeds. At that pool that we split when the property is sold, you get a larger cut of that because you contributed more to increasing that value.
Increasing the value, which makes perfect sense, because if I'm putting down the money and based on both of our analysis, this improvements does improve the value of the property, then we'll be able to establish that this improvement improves it by $20,000. I don't get that money right now, but I get that credit in the back end when the property is sold and where everyone is splitting their share of the property, which is fantastic.
And we do think that's fair, because if you think about certain renovations, we don't know when you're going to sell your home. Certain renovations will depreciate in value as well too. But that credit that you get from us day one, the value of that credit is locked in. So you
That's true.
To it when that property is sold.
That's true. So we buy this property together. It's an investment for you. It's a risk for both of us. And something happens down the road where I have to sell the property because my wife lost her job. We can no longer afford the property. Unfortunately, when it rains, it pours. The property has also reduced in value. You mentioned something earlier. When I am selling that property, I have to pay off the lender. And if I'm $20,000 underwater, I still owe the lender, and the lender is going to come after me for that. So just for clarification, that loss obviously is solely mine. In addition to whatever equity I've put in there, the only risk you have is the risk of what you put down with the buyer.
That's exactly right. So an important thing to note is Ourboro is not on title to the property, and we're not on mortgage. We're not a party to the mortgage agreement that you have. The lender are solely responsible for your mortgage. Our Ourboro not being on title is for various reasons, but in that scenario specifically, yes, our loss is limited to the amount of equity that we put in. We can't, there's no connection to us and the mortgage.
So what that means also then is that a lender has to be comfortable, because part of the mortgage qualification requirements as a mortgage broker is we look at where's the down payment coming from. And so the borrower has to disclose with the lender that, well, I'm coming down with 5% and Ourboro is coming up with a difference. So it has to be a lender that's also comfortable with this co-ownership type of agreement. How does that work? What lenders do you guys work with to facilitate this process?
Yeah, that's a great question. And I think I want to address two sides of it as well too. First of all, from the lender perspective, Ourboro's product actually very much de-risks the debt further, because from our lending partners, they understand that we're like better than a guarantor. we have a vested interest in the property, increasing in value and supporting the homeowners. I mean, and that's kind of the theoretical side of it. But tangibly and legally, Ourboro as a co-owner, we have mechanisms in place. When I talk about supporting the homeowners, we have programs and services, but we also have funding options to be able to support homeowners. One of them is we call it colloquially the rainy day fund. It's called the Homeowners Advance Fund, but it's essentially a pool of money equal to 3 months of your mortgage payment that we set aside. So you never have to contribute to it. It's just money that for every property that we have in our portfolio, we have a reserve set aside equal to 3 months worth of mortgage payments that you can access at any time for 45 days interest-free. And that is meant to help you with any periods of acute financial distress, if you have a temporary layoff, or if you wanted to use this money for an emergency like renovation, or if your roof is leaking and, it's in both of our best interests that you're able to address these things urgently. So that's one example. And Ourboro also, as a co-owner, has a right, but not an obligation, to be able to remedy any defaults that you may be in with the lender. So if you think about that for a second, Ourboro, it is very much not so much worst case, but very much a scenario we would avoid where our homeowners are ever in default. We will do everything in our power to help our homeowners avoid a default scenario, because we never want the bank to kind of take over the property that we own. We want that if there ever is to be a sale, we want it to be on our own terms, right? So the lenders very much see our rights, our tools, and these other programs that we have as buttressing or de-risking that borrower even further. So it is very valuable to our lending partners, and they recognize it from a source of down payment funds. So this kind of segues to your next question in terms of who are our lenders. These new shared equity has been around. It's been done by nonprofits for a very long time. In fact, the government of Canada has a first-time home buyer down payment incentive program, which is shared equity, but it's a bit more like a loan, but it's pseudo shared equity. And from a regulatory standpoint, it opened up just in spring of last year, where lenders are now able to openly consider our shared equity model and have it be an acceptable form of down payment. So we are working very hard to add more and more lenders to this, and we have lots of lenders. We're reviewing our product and are working to be able to introduce it. We're not so much introduce it, but working to be able to accept it, into their systems, etc. But so when buyers come work with us, at the moment, the lending options are limited. We're currently working with Equitable Bank. It's one of our key lending partners. Most of our buyers are working with Equitable Bank. But like I mentioned, we are adding new lending partners. I don't want to date this podcast, but in the months to come, we will be adding more lending partners to the mix as well.
I like the fact that Ourboro is a true partner in the sense that they are looking out for the interest of the homeowner, to help make sure that they don't get into defaults. They will do everything they can, because at the end of the day, you have funds invested in that, and you want to be able to see those funds get a good return, whether that's in 5 years, 10 years, or whatever the case is. And so you will do whatever you need to do to help the buyers keep that property, at least until there are no other options. Now, in doing that, because Ourboro is taking a risk, what's your vetting process like in terms of, if I as a buyer do want to then proceed with, I like this option, how does Ourboro look into, is this a good investor to co-own with, or tell me about that? Yeah,
great question. And I love that you're probably asking that from the perspective of a mortgage broker, because you're doing the underwriting of
right.
The candidate. So it's important for us to start, so Ourboro, we are not a mortgage brokerage, and we're not a lender. We're not in the business of underwriting individuals in terms of the credit checks, the detailed underwriting individuals' borrowing capacity. We rely on folks like you and the lenders to do that. In other words, if you can qualify for a mortgage, right, from a tier 1 financial institution, then you qualify to work with Ourboro as an individual.
Okay.
That said, our vetting and our underwriting is actually more at the property level. So, right, our investment team, a big part of their role is looking at what are the regions that are best poised for growth over this next, like this 5 to 15 year period, or even, always even beyond that. And then at an individual transaction level, our intake process is that when buyers are bidding on properties, if there's a property that they are wanting to put an offer on, they let Ourboro know ahead of time. And we do like a very quick, almost instant desktop evaluation of that property to set a maximum bid price. And that maximum bid price it's not meant to be a limiter for the buyer. It's meant to set the ceiling, because that's one of our value adds. We're there to not make that like emotional decision and for a property. So we do, and our buyers, honestly, they get peace of mind knowing that there is this like this professional company who is looking at the property they're wanting to get and kind of give you that stamp of approval and like for that property, right? So we have that process in place and to help really, us and our home buyers know that they're buying the right property for the right price.
So what that means also is if Ourboro is doing their due diligence on the properties, you're also looking at properties that are in areas that are poised to grow in value, which also means that the areas which you will go into a co-ownership agreement, what areas are those for our listeners?
Well, we don't do it at a neighborhood level. I mean, we do kind of, but indirectly. Like if we, if somebody is looking to make an offer in a neighborhood that we know is overvalued, we might set the maximum bid price a little bit lower. And fortunately, like the market has been accommodating. Obviously, we take into consideration that, if this is a property that's holding off offers and they're anticipating like bidding wars, etc. We take all that into consideration. But at the end of the day, a competitive property is a competitive property. And so we consider that. But regionally, that is one of the reasons why we are limited to certain regions at the moment. So currently, our portfolio is co-investing in the GTA, the 7 regions of TREB that defines the Greater Toronto Area: Hamilton, Kitchener-Waterloo, London, and Guelph. Those additional municipalities are also regions that we just recently expanded to in February of this year.
So when we say GTA, does that, you mentioned most of the parts you mentioned are more on the west side of things. Do you look at areas like Oshawa, Bowenville?
Yeah. Whitby, Oshawa,
Newcastle,
part of Durham region, which is part of the TREB. It's part of the TREB catchment
area.
Okay.
Okay.
Yeah, as far east as Durham region.
How far north do you go?
Oh gosh, you're really
Barrie, Innisfil,
Simcoe. So that's is that Simcoe, Dufferin County?
Yeah, that's Simcoe.
Yeah, so we do include that region.
Okay, so it's a pretty big, wide area that even if a buyer is unable to find in the core GTA, you can still maybe go maybe an hour and a half and still find a property that is reasonably priced that you may be able to.
That's correct.
Come alongside them. Yeah. Now, let's talk about exit strategy. So I come into this ownership agreement with Ourboro and I decide, well, maybe it's time to pay Ourboro out. Or how does that work? Do I have to sell the house or do I just have to let them know and then there's a valuation done and then maybe the buyer arranges their own refinance privately to pay them out? How does that work?
Yeah, for sure. So homeowners can co-own with Ourboro for up to 30 years. Our co-ownership agreement, it's a 30-year, which is mind-blowing, but it's considering that the home, everybody talks about buying a home and just this like emotional roller coaster of buying a home, but that's just like 6 months of our relationship with you. The bulk of it is like once you're in the home, we have years of working with these folks. But anyway, so at any time during our co-ownership agreement, buyers can sell. They have the occupying owner has the sole right to determine when and if they sell during the period of the agreement. So at anytime before the 30-year period, it is entirely up to them. Ourboro cannot force you to sell unless you are obviously like in default of our agreement for whatever reason. Ourboro cannot force you to sell. Even if the markets are down, we get asked it a lot. We're like, oh, if markets are really down and I need to sell, like, is Ourboro going to stop me? Absolutely not. Like if, our interests are, it's really, people don't understand, like our interests are aligned. We trust that you don't want to sell at a loss either. Maybe ridiculous.
Correct.
We want to make money as well, right? You wouldn't voluntarily want to sell at a loss. And so if you are ever in a position where you need to for life reasons or financial reasons, then we absolutely should not get in the way of you needing to do that.
Okay.
And so you can always sell at any time. If you want to buy out Ourboro, that's the other exit strategy. If you know you want to stay in the property beyond the 30 years, you've come into some money and you want to buy out Ourboro shares, so you stop sharing appreciation from that point on.
Mm-hmm.
Individuals can offer to buy out our share at any time. And I like to give the example if you and I owned a home together, whether we lived in it together or not, but neither party, you can't force me to sell my share to you, right? Especially if markets are down, you can't force me to sell at a loss. And it's kind of the same with Ourboro, but we didn't like that uncertainty. We wanted to create a little bit more transparency for homeowners around when Ourboro could sell their share, when they can buy out Ourboro. So in terms of exit and for people's planning, we say that if a property has met our minimum rate of return, so if you want to buy out Ourboro, the steps are you let us know you want to buy us out. We go through a process to determine the fair market value, most often through third-party appraisal. So there is a fair market value that is assigned to the property. And if that fair market value is above our target rate of return, then Ourboro is actually obligated. We said we will, we're happy to be obligated to sell you our share. If that fair market value is lower than our target rate of return, then we negotiate a price that's mutually acceptable.
Okay. That was a question I'm assuming the internal rate of return that you have set, it's something that you keep within your company. You just look at the numbers, or is that something that is public knowledge?
We're transparent about it. We use a target rate of return for that specific equation for a buyout scenario of 6% year over year. So if you look at real estate accumulation in Toronto or in the GTA over the last 50 years, at any 10-year period, there's been at least 7.5% year over year return. So we set our target rate of return a little bit below that specifically for the buyout calculation. But yeah.
I love the fact that you guys are transparent to a lot of these things, right? If a buyer wants to sell it, if it meets your 6% rate of return, what you expect from it, then it's in your best interest to buy the owner out. If it's less than that, you're willing to negotiate and see if you can come to sort of compromise.
Exactly.
Now, when it comes to selling, typically there's real estate fees and all of that. How does that work?
Yes, great.
And even on the buying side as well.
On the buying side, yeah. So simply put, closing costs are the buyer's responsibility with a few exceptions. Land transfer tax, because land transfer tax follows beneficial interest. And because Ourboro is having a beneficial interest in the home, we pay our portion of land transfer taxes. And that is significant because land transfer taxes is 80% of closing costs.
The closing costs.
Yes, especially if you're buying in the city of Toronto where you're getting double taxed.
That's right.
Right? So if Ourboro is contributing 75% of the down payment, we're contributing 75% of the land transfer taxes. So those are huge economic savings for a buyer on day one. At the time of sale, the biggest expense is realtor commissions. So first of all, we have our network of trusted realtors that, we can work with, or buyers obviously, may have the option to work with their own. But we like to be able to have confidence that we're working with trusted realtors who are really working to get the highest price possible when it's time to sell.
Right.
But anyway, so realtor commissions is the first. On average, is about 5%. Sometimes you may get a deal, but that's the biggest selling expense. So that is, again, the occupying owner's responsibility. However, if the property has exceeded our appreciation expectations, then Ourboro can provide the homeowner what we call a selling bonus, where we contribute towards those selling costs as well too. And that's
okay.
Yeah, and we can contribute anywhere from 10 to 100% of the selling costs, depending on how well that property.
How much appreciation has. Yeah. Honestly, I think this is a really great program, especially for those looking to get into the real estate market for the first time. You have your 5% down, Ourboro comes alongside you. And a lot of times people just need to get in, right? You just need to get in. Hopefully in a few years, properties has grown in value.
Yeah.
Financially, the buyer is also in a better place where they could even qualify for more mortgage, at which point they can refinance the property, pay Ourboro out, and now they can move on and they can make bigger purchases on their own.
Yeah.
And one of the things that hasn't been mentioned, but I think is important for this conversation before we wrap it up, is that this is meant for homeowners who want to live in the property,
yes,
not investment properties.
Exactly. And that's like the core of Ourboro comes from social impact roots. Like we are about, our mission and vision is about democratizing home ownership. And so at the moment, our product is for those who are going to be living in the properties, not for those looking to, purchase like a rental property. That said, if you're living in the property and you have a basement suite that you want to rent out, you can do that and you can keep 100% of the rental.
That's fantastic, actually, because if a homeowner is looking for a property, one of the things they can look for is something that has a basement suite, and they can generate rental income from that property, and it's all theirs to keep, but they didn't have to go in by themselves. This is a really fantastic strategy. Before we wrap up, I have one more quick question. Pre-construction projects. Is that something? I know I have to say.
I know, and we get asked it so many times. It's so different, right? Pre-construction is so different when you're buying from a developer because first of all, there's a timeline. Like you pay your deposit in year 1 and you don't get occupancy until like year 4, however long it is. And so there's just this like intrinsic incompatibility with our model when we commit funding versus when we deploy it. And also HST is the whole thing. So I'm working on it. We're working on it, but not at the moment.
Okay, no problem. I will keep you for much longer. Alex, this has been very informative. I really appreciate the time you spent educating us about this program. Before we wrap up, can you tell us more about if a listener is ready to jump in? What's the process like? How can they get a hold of you or get a hold of somebody from your team?
Yes, thank you. So we have a wealth of information on our website, and we invest so heavily on education because we are a new product. It's, you mentioned transparency. We take it very seriously, being able to give people the information they need to make an informed decision. So first and foremost is our website, ourboro.com, ourboro.com. There you could submit an application. There's a get started button. You could also contact us. There's a form, like a quick get in touch thing, and somebody will call you back very quickly. You could also email info @ourboro.com. That's our general inquiries inbox. And last but not least, I think social media. We are on all the places. Also Threads. Our team had us on Threads within the first day. I was very impressed.
I still have to join. I haven't yet, but I heard it's blowing up.
Yes, exactly. So our handle on all the platforms is Ourboro, OURBORO HQ.
Fantastic. This has been really helpful. Alex, thank you very much for your time, and thank you for today.
Pleasure.
And thank you for joining us on the True Wealth Podcast. Until the next time, have a wonderful day.
This is all the time we have for today. Thanks for listening to the True Wealth Podcast. Don't forget to rate, share, and subscribe to the True Wealth Podcast on your favorite podcast platform. Follow us on Instagram, Twitter, or Facebook at True Wealth Pod. We'd love to hear from you. Share your thoughts, ideas, and questions with us on our social media platforms or email us at podcast@truewealthadvisors.ca. And who knows, your question might be the subject of a future episode.